Take two. This is the 16th of February, 2024, and it's going to be a short one because I got a pile of stuff we got to get after today. But here is what we've got. So today we've got the housing starts, building permits, and producer price index. We also have consumer sentiment coming out through University of Michigan. So let's just kind of share that screen real quick. So housing starts will tell you how many are starting to build homes, what homes had just started construction, right? So what we've got here is a decline in what was forecasted. Now everybody's going to say, well, it has to do with winter being on us and impacting cement. Well, yeah, but that was already factored into the forecast. So it's less than what was anticipated, even though winter's here, that anticipation was still going to be there based upon what permits were before. New building permits down again. So construction is not growing. It's shrinking more than what they thought. Now, there's still new construction, right? They're still expanding. It's just not expanding as fast as they thought. Inventory is not keeping up. We know that. Now we've got producer price index. This is another measure of inflation. This last week, first part of the week, got CPI, much higher than what they anticipated, had a huge effect on the market. We'll go back and look at that. Now today, look at this. They anticipated 0.1%. We got 0.3 for the PPI. The core PPI, they expected 0.1%. We got 0.1%. We got 0.5. That was a big jump. That's a massive jump. We're also getting the consumer sentiment. It's slightly lower than anticipated, meaning people are not buying what like they would have thought they would. Now it's small, but it's still showing a direction that was different than what they anticipated. What does these things mean? So let's move right here. Okay, so what is this going to do for us, right? So we've talked about, main thing is the inflation thing. So if inflation's going up more than they anticipated, that means the dollar that we're using to buy things with is losing its value, losing its buying power. Therefore, anything that's a long-term instrument like a bond, 30-year fixed mortgage, if you're investing in 30-year fixes, right? And I'm going to take these off because I need it for right here. But then when I look at the other screen, I need them back on. So if you're investing in a 30-year fixed mortgage, you're an investor, puts money into the mortgage-backed securities, which I'll show you the charts on, and you expect a rate of return. And that rate of return is going to be spread over 30 years. And the dollar you're getting every year is worth less and less and less. You're making less money. So you may not be as interested in going there. Maybe you go over to equities, something else that's going to maybe have less risk of losing money. It's going to grow for you. So, but if you're in a situation where the economy is hurting, right, things are shrinking, the inflation's going down, that means people aren't spending as much money. Companies aren't making as much money. Maybe you pull out of the equities and go into bonds where you'll have it sit there for a long term and know what your rate of return is going to be, and inflation is not eroding that dollar. So that's kind of the thought process behind it, very generalized thought process. So let's look at these bonds, these mortgage-backed securities. Again, another bond, putting money in there for 30 years, getting 5.5% on it for 30 years. The interest rate's going to be higher than that, of course, because everybody's got to make money in it. This represents the day we received the CPI, Consumer Price Index, showed higher inflation. What happened? We lost it hard. We broke through. I mean, look, we were teetering on this as support versus resistance. This particular line right here at 99.33. We fell below it the day before CPI was released, because usually we're talking about something that's going to be a market moving type index. They kind of hedge it, and they put themselves in a little bit more of a negative position, sell some stuff off in advance. CPI came out, it was ugly. We broke through this particular support at 98.89. We broke through again on 98.72, and now, or actually 98.70. Now we're sitting right now. We actually stayed low here, below this 98.70 line. We got almost to the 100-day moving average. But look at all the averages we have above us. We have the 14, the 21, the 35, the 50, and the 200, all above us. All above it. That is all resistance. Actually, no, sorry. We have the 200 right here. You can barely see it. 200 right here is acting as a support. So we have 200 to support. We have the 100 to support. We have that 200 seems to be pretty strong to help us out here. So we bounced off that a few times. Now, today's news didn't help us, but it doesn't look like it's hurting us real bad either. This was yesterday. What's crazy about yesterday, we were up. We had a day where their trading was up, bonds were up. We should have had pricing stay the same, if not get a little bit better. At the end of the day, pricing got worse. Why did it get worse? Like, why would you raise the cost or the rates just a little bit? Because they're preparing for this. They knew if CPI was what it was early in the week, then this PPI might be weak. And if it's weak or higher than what they anticipated, then we're going to get hit. And what they do, they got hit. Now, it got hit pretty hard this morning. It's come back. I don't know how long this is going to hold. It should hold. I would imagine it would hold. We got two really, really solid floors here. But what we have here is we can't expect things to keep getting better if the inflation readings are coming out worse. The other thing about these inflation readings, the Fed talks about we got inflation under control. They're going to lower rates. It's not happening. There's anybody who thinks that they're going to lower rates this first quarter, not going to happen, guys. It's already been taken off. So don't talk about it. Second quarter, maybe. But we're not seeing inflation going the direction they want it to go for them to be willing to lower it. So it's a possibility that it keeps doing this. These little tiny tenths of a percent higher, guess where we're going to go? They're going to leave it. And I think they should. Aaron Chapman thinks they should leave the interest rates alone. The Fed should stop doing any sort of movement. Let this year shake out. Let the market dictate. And when the market dictates, we'll see what rates really will be. And we won't have this craziness in the market pushing prices to the roof as far as houses is concerned. Now, right here, I'm going to remind you, anybody sitting here thinking, well, maybe rates will go lower. Look what we've got. We've got this resistance right here we got to bounce off of. So we've got to get past that. Some good economic news saying, well, it's got to be news that makes the economy look like it's slowing down a bit and that things are not as crazy out there. The inflation is not going up for us to push through these things. That's what happened back here. That's why I pushed up here so hard. But all the things that came out negative, or as far as showing the economy is harder than it should be, is pushing us below these moving averages. Now look at all these moving averages. Look at them. These are now all ceilings. We're not getting back up here real easily. It's going to be tough to get there. That 100.53 line to me is the ceiling. I drew it a long time ago. It's ignored by all the people. But that right there, to me, is the ultimate ceiling. It's going to keep us from getting much lower as far as interest rates. I am going to continue to say, lock, lock, lock. Protect yourself. We're not that far off of the lowest rates we've seen in the last few years. But if we go below these things, we can get back into the uglier side of things. We can fall back into that channel again. So just lock it. And quit asking if the rates go down. Quit asking for there. Just know that anything the news tells you about the rates going down is old stuff. If they're talking about the rates going down, they're probably talking about 2 days ago right now. So I'll keep just saying it. Lock. Be careful who you're talking to. If they ain't talking about this kind of stuff, they don't know what the hell they're talking about. Anything they bring up about rates is hope. Everybody says rates are going to go down this year, or actually right this month. There's somebody talking about. I have to find this and I'll put it out to you guys. I said February is the month for the rates to go down. They've been nothing to go up all through February. So if they go down, they're going down from where they went up to, right? So where they started to where the rates are now, the rates went up. And if they go down, it's probably somewhere in between where they started, where they went at their highest point. So they did nothing but go up from the beginning of February, but somebody's going to claim that as a win because it went down at some point. You got to think of who you're listening to. There's a lot of fools out there trying to suck you into this. Talk to you guys on Tuesday.